All right. So one of the questions I get a fair amount is in regards to assessing properties and how we do it when we are looking at doing any deal between $2 to $20 million. So we're going to talk today a little bit about multifamily because the multifamily dynamic. I'm just going to move this a little bit closer so you can have better audio. The multifamily dynamic really relies on essentially a blend of different key performance indicators, such as some people might want to talk about, per square footage cost. And we want to talk about raw land cost per square foot, unit price, land price per unit. So you're going to take the total amount of units divided by the land and get a total of how much, dollars per unit things are going to cost. And so those are all really great. But you're not going to have one single dynamic be able to determine if a deal is worth doing or worth walking away from. So what we do is we take all those critical informations, we take the components of the price per square foot, we take the build cost per square foot, we take what the rental rates per square foot, and we base them all down. And what we really want to get to is we want to get to the financial certainty and the superiority of knowledge that tells us that this deal is going to be worthwhile doing, because it has to create margin. Now, when you buy land, essentially our belief is that the day you buy your land is the day you make your money. Because if you overspend on your land and you don't mitigate your risk, you're going to end up in it's really uncomfortable situation that you're going to have to be feeding the beast. And feeding the beast sucks. I've had to do it before, and it's not any fun because you make some preliminary mistakes on the front end, and then you're chasing things on the back. And so you're trying to drive down costs too much. You're jeopardizing reputation, relationship with your trades and suppliers, and it's just not really enjoyable to be in a deal that isn't making any money. Because the best way to kill your passion in real estate is to have to be feeding the beast every single month on a project, to be writing a check because you're underwater and you got to get to the next mortgage term or the next year, or you got to sell equity to get some cash out or whatever it is. It's just not a comfortable situation to be in, and it makes you motivated to sell. And that's a great opportunity for new investors who are going to buy that property from you. Not so much if it's one that you own. So when you're looking at the land assessment, we think it's really critical to have land under contract for as long as possible, and to be able to do things in the terms and be able to build relationship with the seller, so that you're actually going to create an asymmetrical risk for both you and the individual. Because the last thing that the individual wants, who owns the property, is to tie it up and be working with someone who's not able to close. A lot of people who wholesale properties, they have the We Buy Homes cash, they're not really buying it. Like, they're flipping it to someone else. And so it's the ability to complete is really critical, especially for people who own land over $1 million, like just raw land over $1 million. They want to know that you can close, and they want to know you've got parameters, that you've got experience, that you've got a phenomenal team behind it that's going to help you, pull the trigger and actually execute things with excellence. So when we're looking at a cost, we get to the point where we want to know about how much equity we're going to need for cash in the deal, left in the deal, the land value, what the land value to the deal is going to be worth, what the cash flow is going to be to generate our cap rate and essentially our cash on cash return, because we believe in our investment thesis that revenue is vanity and cash flow is sanity. So when we focus on those things, it eliminates a ton of deals right off the hop, because we're not really big into speculative markets. We want to be able to know that we can make cash when we're done, and that it's going to be a joy to be a part of and refinance as we move forward. So that's one of the critical things. The other capacity that we look at is rent per square foot. So we want to know how much rent per square foot we can generate per unit size. Now, when we design buildings, multifamily buildings, we mainly find that there's about an 80% efficiency usage between the total area that you're building and the area that is actually net rentable. Now, when you take that and you eliminate, lobbies, entrances, stairwells, hallways, mechanical rooms, and you look at all those things, we base it based off of 80% efficiencies. And we try to do better through very intentional design, but that's kind of one of our base categories. So if we're building, 100,000 square foot building, we would have 80,000 square feet of net rentable area. We would then take that and say, well, do we think we can get $3 per square foot? Take 80,000 times $3 per square foot per month. And then you're going to times it by 12 to get an annualization for your gross income. You're going to take 30% expense ratio. We don't know what the individual expenses are going to be for taxes, utilities, property management, all those other things. But be sure that you put property management in there, because, well, for us, We don't want to do the day-to-day management. We are profitable enough to pay a phenomenal management team that can take care of the people in the process of dealing with those tenants short-term, long-term, and really creating an environment of excellence within the building, just like we have an environment of excellence inside of our company. So we're really focused on being able to do that because we think that, being able to create that environment is really, really, really important, because without that environment, you don't have an ability to be excellent. So back to the core numbers that we really think, that I really believe are going to be critical, is your net rentable area, your square footage costs that you can get rent for. Smaller units are almost always better. You're going to look at having, capacities in multifamily for using MLI Select, which is great, but you have to understand that sometimes that type of building approach might not be the biggest bang for your buck. It's not always the best. High leverage and those things are not always the best. So, and then you're going to have to realize how much cash you're going to need to leave in the deal long term, and mainly how much net worth you're going to have. And then you got to do the deal structuring. So the deal structuring is also a completely different beast, something that I really enjoy, and, spending about the last 5 years reading and talking to authors and people who actually do deals and are structuring deals with GP, LP structures and things like that. I've really been able to understand like the simplicity of the right deal, and the more complexity and the bigger the paperwork stack and all those other things, the less it makes sense, in my experience, to be able to look at these deals where there's very complex components, where maybe you're dealing with a lot of entry-level investors, non-accredited investors who really haven't been able to create a high net worth income or a multi-six-figure income for multiple years. Sometimes they just don't understand how money works at that next level. And sometimes I've seen a lot of people who have a lot of wealth based off of just market appreciation. They've owned a property in a great area for years, and good on them for that. That's going to give them a lot of options. And they also really don't understand the component with money and how money doesn't add value. Great working partners do, because we're the people in the trenches. We're the ones who are working our butts off. And essentially, at the end of the day, there's a lot of money out there to choose from and who you want to partner with. So the deal structure and components, once you have that structure, then you're going to have to go into your net worth capacity and figure out what is the net worth guarantee that you're going to need. Is it 50%? Is it 100%? There might vary inside of construction as well, which is something that you really need to consider, because if you think that you're going to be able to have 95% loan to value on everything and you're not going to have a net worth, construction lenders and lending in terms of construction and the private world, the conventional world of financing, private funds, big five funds, things like that, everything's a little bit different. So you really need to dive down and understand, how do you make a pro forma that is so dang good, that has bankable numbers that any lender or banker will want to be a part of. Any investor will want to be a part of, because you've done your due diligence. You've got the cost or target cost certainty numbers back. We're actually creating an environment of increased certainty, and you're creating an asymmetrical risk where you've got margin and you've got good contingencies and you've got really smart people behind you. So that's one thing that, in building our company out, it was important to integrate, the old school way of doing things along with, like the tested, proven, been there, done that, they work. And then blending that with the modern world of today, with the technologies that we have today, the artificial intelligence, all those different things, and where I don't think that artificial intelligence is going to take anybody's job. I think that someone using artificial intelligence is going to outcompete, and because clients always want faster, better. And so by meshing that together and really blending and vertically integrating those new tactics and strategies of today with software, speed, information, marketing, and sales are critical. The construction management, you still need really good boots on the ground men with good information and software, because you have all the analytics in the world on a job site, but if you don't have good men running and leading that job site, you're just going to run into nothing but problems. So I know we covered a lot, but in the brief summary of things, the critical numbers that we look in for are, what is our land cost per square foot? What is our land cost per unit? What is our revenue cost per unit per month? What do we get for rent? Is it $2, $3, $5? What can we get? What are the building costs? We use 30% as a standard ratio, and our obligation and our pursuit is to value engineer those to be lower. And then as far as build costs, it all depends on specifications. So, we've done buildings that are 250, we've done buildings that are 180. It just depends on what's going in and what type of conditions that you're having. And I would also invite you to consider, when you're using your foundation numbers, be conservative with those when you're designing out a building, because that's where a deal can get really messy really quick if you don't do good research on the front end. And I understand that a geotech report isn't cheap. It's like 30, 40 grand, and the study is maybe 10 or 15. So maybe you're in 50 grand on, $1 million piece of dirt and due diligence, but you don't want to end up with soil that doesn't comply with the size and weight that you're looking to put on. I was personally involved in a project where the original land was thought to be able to build about a 12-story building, and essentially the geotech report came back and there was no way that you would want to pay for that kind of foundation engineering to go in there. And so it ended up being rezoned back to townhomes, and townhomes were built on it at a significant difference between cost and price. Cost of the original purchase of the land to what the original person thought they could actually get for it. So there's lots of different things to really consider when you're doing land, but it's never a single variant that's going to de-risk it for you. It's going to be something that is a multivariant approach where you've got all different kind of components, but then what that really comes down to with all the data is you have to have a bankable team. And the bankable building team is going to be the most valuable asset, both to give you target cost certainty and also the understanding and the conviction from a bank or lender that they should in fact lend to you when the pro forma is done. Because the last thing you want to do is spend all this time and have hypothetical numbers and not have to be able to, or not have a company who's willing to stand behind the numbers that you've put together. So with that, I would just invite you to consider those different things. Covered a lot, but that's just multifamily. We're going to dive into a few different options when it comes to commercial structures, industrial, and then obviously one building that we're pursuing right now in Beaumont, Alberta, which is a mixed use medical building, which is essentially like an east meets west venture between health and potentially with the city of Beaumont, along with the library as well. So stay tuned for that one, and we'll be coming to you guys with a couple other episodes in the future very quickly on car washes, townhomes, mixed use, multifamily towers, and then some flex space as well.